everyone. Welcome. Super excited to have you all here. My name is Sedale Turbovsky. I am the CEO and co-founder of OpenGrants, and really excited to have Jonny Price here from Wefunder. This is the Equity Crowdfunding in 2022 webinar. And if you are here for that, then this is the right spot. If you are not here from that, you should stay because it's going to be really awesome. We are going to have a really great discussion about what equity crowdfunding is, where that fits in the capital stack for founders, and dive into a little bit about like what the current market means for this space. And we're going to have a great discussion. So super excited to have you all here. As we let people roll in, I just want to talk quickly about a couple of housekeeping things. So for everyone's safety and security, we have this fairly locked down. If you do have questions for us, and we will have Q&A at the end, please feel free to use the Q&A tool. Chat will be unavailable. We will also have this available as a recording post. We will create a transcript and we'll send it out over social channels, as well as if you signed up with your email for this, you'll get a follow-up email with that information. So super excited to have you all here. Once again, my name is Sedale Turbovsky. I am the founder and CEO of OpenGrants, and we are the easy way to win grant funding. We put on these educational chats to not only educate our community about capital, but also to really expand. And one of our main goals is to get folks to think about the capital stack super strategically, think about where different kinds of capital can come in and fill a need, and how you can use those different tools to move things forward. And of course, our expertise is grant funding, but I'm super excited to have Jonny Price here. He is the VP of Fundraising at Wefunder, and I will let you introduce yourself, talk a little bit about who you are and what you're up to, I guess.
Yeah, absolutely. Can you hear me okay?
Yes, loud and clear.
Great. So yeah, Jonny Price, VP of Fundraising at Wefunder, as you can see on the slide. My resume in a nutshell is that I grew up in the UK, started my career in strategy consulting over there for a firm called Oliver Wyman. Did that for 6 years. Partway through that, came to volunteer at a nonprofit in San Francisco called Kiva.org that does crowdfunded microloans for entrepreneurs around the world. That's what brought me over to the left side of the pond. I joined Kiva full-time in 2011 to launch their US lending program. So most of Kiva is known for supporting entrepreneurs in Africa and Southeast Asia or South America. And I led the team that was bringing that model to support mom and pop shops, small businesses here in America. So ran that for 7 years. And then a few years ago in early 2018, came to join Wefunder, which is also crowdfunding for entrepreneurs in America. Slightly different model, as we'll get into. Most of what we do is equity. We do some debt as well, much larger sums. So the Kiva loan was average $5,000. The average campaign on Wefunder is about $400,000. So yeah, excited to tell you guys more. My role on the Wefunder team is basically top of funnel, working with founders as they're evaluating their different fundraising strategies and helping them understand the pros and cons of raising money from their community and customers on a platform like Wefunder. So lots of conversations with founders, and then helping them to get set up and get set up for success on the platform, raise as much money as possible. I've been doing this for 4.5 years. Really love it, love the role, love the team. It's a very mission-driven company. We're a public benefit corporation and a B Corp. So we have a really clear mission to democratize angel investing, let everyone invest in startups, not just rich people, and also get more capital flowing to founders, and especially underrepresented founders, by enabling them to pull in capital from new pools. And so yeah, also excited to talk more about our mission over the next hour, but great to be here. Thanks, Sedale, for the invite.
Awesome. Yeah, my pleasure. And as you mentioned, one of the reasons we love Wefunder, we raised capital on Wefunder, is because of this, this mission of kind of democratizing access, not only to capital for founders who are looking to raise, but also democratizing access for people who are interested in investing and getting into this asset class, which I think is super exciting. As a founder, I hadn't really taken a look at Wefunder until we raised capital, and I just started kind of putting together my first sort of deal memos that I just sent to my wife, and I'm like, hey, can I spend money on Wefunder, please? Yeah, love the platform, love the ethos and the mission. And just want to say again, thanks everyone for joining us. Please use the Q&A tool If you have questions, we will open this up for questions after. Before we dive into our first question here, and just kind of like cover like what is equity crowdfunding, definitely want to just take the temperature of the room out there. Thank you all for joining us. Let us know how you're feeling. I know there's a lot of things happening in the world, some of them super exciting, some of them kind of depressing. And, would love to know, like, what are you excited to learn about today? How are you feeling? So do participate in that. And as your answers come in, the first question I want to tee up for Jonny really is like, what is equity crowdfunding? So while we think about that, it looks like a bunch of folks are participating. Everyone mostly excited and energetic, cautiously optimistic is coming in close second, looking for some midweek inspiration. So hopefully we can really get those, deliver on all of those things. So really excited to have you all here. I'm going to go ahead and end the poll, and we can dive into that first question. So you talked a little bit about transitioning from Kiva, which is a bit different, to Wefunder, and talked about this like different kind of crowdfunding, which is equity crowdfunding. So can you just like give us the one-on-one, like what is equity crowdfunding? How is Wefunder different from, say, your Kickstarters or other crowdfunding platforms that are out there?
Yeah, absolutely. So Kickstarter, Indiegogo, two biggest examples of perks-based crowdfunding. So you're basically, oftentimes it's like pre-sales, or it's kind of donations oftentimes, and maybe you're getting a t-shirt or something in exchange. Maybe you're getting a discount on a product, but it's kind of pre-sales oftentimes, or donations. With Wefunder and investment crowdfunding, the people that are backing your round, investing in your company, they are actual investors in the company. And we call it equity crowdfunding. 95% of investment volume on Wefunder is equity. We actually do allow for some debt offerings as well. So just like a bank would lend to a small business at an interest rate of 8% or whatever. So you can borrow money on Wefunder. So we do debt as well as equity. But the key difference of Wefunder versus a Kickstarter is this is an investment. And then what that means in practice is that because you're offering the crowd investors the potential of making return on their investment, they are oftentimes willing to invest a lot more money than they would kind of buy your product for or back you on Kickstarter for. And so the average Kickstarter rounds, I'm forgetting the exact number, but I think it's in the order of kind of 40 or 50K, something in that ballpark. The average Wefunder raise is more like 400K. The average kind of contribution on Kickstarter is $80. On Wefunder, it's $1,000. So if you're giving people the opportunity to invest in equity in the company or lend to the company with a hope of return, you can usually raise a lot larger sums of money. So that's kind of Wefunder as opposed to Kickstarter, or investment crowdfunding as opposed to perks-based crowdfunding. And then the other obvious comparison is comparing to how startups historically, and the vast majority of startups today, still raise money, which is from accredited investors. An accredited investor is an individual who's basically a millionaire. It's like you're making like 300K of household income, or you have $1 million of assets excluding your primary residence, your house, or an institution like a VC. And so normally when startups are raising money, they're raising from VCs, they're raising from accredited angel investors in large checks. And they use an SEC exemption. It's like a way of raising money. SEC exemption is the technical nomenclature for it. But the SEC exemption is called Regulation D. That's how the vast majority of startups in America are using Regulation D to raise money. With Regulation D, there are two things which are different to Wefunder. Firstly, you can only raise money from accredited investors. So roughly 8% of the population are accredited. So you can't raise money from 92% of the population. And then secondly, generally, there are exceptions, but generally you're limited to privately soliciting investors. You can't, for example, post on Facebook and say, hey, we're raising money, come check it out. So with Wefunder, we use a different SEC exemption. Instead of Regulation D, we use what's called regulation crowdfunding, Reg CF. And with Reg CF, both of those two things are I would say, fixed, or certainly different. So firstly, you can now raise from everyone. So 100% of the population can now invest in you, not just the richest sliver. Accredited investors can still invest. Accredited investors account for about 50% of investment volume on Wefunder. We have a lot of, rich people writing 10, 20, 50K checks on Wefunder. But then 50% of the investment volume is coming from unaccredited investors. And again, like I said earlier, this is a really important part of our mission, which is basically, why should only rich people get to invest in startups? Why should only rich people have access to invest in the next Uber or the next Airbnb? Shouldn't we let everyone participate in these wealth creation opportunities? Just as anyone can invest in the public stock market, just as anyone can invest in crypto, just as, why should it be that anyone can't invest in their local coffee shop? We do Main Street businesses as well as tech startups, or invest in a startup founder that you went to college with. So let's kind of democratize it and let everyone participate as an angel investor. So that's kind of the first difference of regulation crowdfunding, is now you can raise from anyone in your network, anyone in your LinkedIn connections, any of your customers and community. And then the second big difference is that now you can publicly promote. So you can tell everyone about it by posting on social media. You can put out a press release. You can go on a webinar like this one and talk in depth about the company and the investment opportunity. We also have 1 million investors on Wefunder that we put you in front of. Typically, they're bringing 20, 30% of the rounds. So the lion's share is on you as the founder to hit up your network and pitch it and raise the money. But usually you're getting a boost from Wefunder investors as well. But those are kind of two of the real important differences between raising capital conventionally through Reg D from angels and VCs versus raising capital through regulation crowdfunding on a platform like Wefunder.
Yeah, that's great. Thank you for that description. I love the thing that we loved about it personally was a lot about not only the democratization, like we wanted more people, not just accredited investors who we love and we love working with, but and to kind of lightly touch on, there's a huge opportunity for us. We see, our customers are particularly passionate about our platform. They love it. They love what we're doing. And, most of our raise, in fact, came from those folks. We were able to just go out and say, hey, OpenGrants users, guess what? You can now invest in OpenGrants. And it was a great message. And it also goes to the kind of the core of some of the ethos of what we're building at OpenGrants, which is the idea that down the road, we can deeply incentivize not only, people at companies, but also people who are participating with companies to continue to use a product and continue to help the company grow, provide us feedback, insights into how we make the product better. And if they're an owner, they have that ownership, right? As an investor, they now have some ownership in the company, they have some skin in the game. And so, it's a great tool. I love, you said you've been doing this for 4 years now. And this is why, one of the reasons I was super excited, I think pretty early on when we were working with your team, they started giving us all these stats like, a certain percentage of folks who actually commit, fully convert to become investors. And there's all this really great stuff. We found a lot of support from the Wefunder team. I wonder if you could tell the founders, because I'm going to go ahead and say that there's a lot of folks on here who are probably interested in knowing how do you do this successfully. What are the kind of things that you've seen that really separate successful from unsuccessful fundraising efforts on Wefunder? Maybe
I'm gonna answer that question, but I'm gonna do the classic interviewee tactic of just if a journalist asks you a question, you're just I'm going to answer a totally different question. But then I'll come back to that question. Before I get to that, which is what makes success on Wefunder, let me first outline kind of 2 use cases for Wefunder. So this is if you're a founder considering this option, for me, there are kind of two primary use cases for who is a good fit to raise on Wefunder. And the first is if you need help raising the capital. So, maybe you're kind of a little early and you kind of don't yet have the traction and you kind of, you want to push the conversations with angels of VCs is too early. Conversations with angels are maybe going slowly. And this can be a way to push the gas pedal. because you can still have those conversations with angels, whatever fundraising tactics you were doing in a Reg D world, outside of WeFunder, you can still be having those conversations, and you should. But now you can also publicly promote it, push it out to, text like everyone in your phone saying, hey, check it out, get in front of WeFunder's investor base. And so I think oftentimes we can help founders raise more money more quickly. So that's the first use case. And the second one, and this is kind of to your point on what you guys, enjoyed about and saw value in with WeFunder. And this is, I think, the cooler use case, because the first one, like, if you need help raising the money, you're struggling to raise the money, you're probably also going to struggle on WeFunder. It's going to be a bit of a grind. I think we make fundraising easier, and we want to be expanding access to founders that otherwise would struggle. And it's a big part of our mission, and there's definitely a need there. But with the second one, it's like, maybe you don't need the help raising the capital. You can easily raise capital. You have angels and VCs lining up to invest in you, but you just see a lot of value. You buy our hypothesis that if you can convert your community and your customers and your users into investors and owners of OpenGrants, then they're going to be more loyal customers. They're going to be more passionate brand ambassadors. They're going to have a higher net promoter score. They're going to tell all their friends about it. They're going to help you with hiring. If you send an update saying, hey, we're trying to find a designer right now. Do you know anyone? You now have like hundreds of people that are financially incentivized to help you find that designer. And so that is like the real sweet spot for me. And so one of the coolest companies, the second coolest company that we've had on WeFunder after OpenGrants is this kind of banking quotes for startups called Mercury. And so they're kind of redesigning banking for startups. Really cool company. They raised a 120 million Series B from Andreessen Horowitz and Co2 and other VCs. Did not need the money, right? Very obviously, could very well funded, had the best VCs in Silicon Valley throwing money at them, opened up $5 million to let their customers invest. They funded that $5 million in one day, 2,500 investors, by sending one email, just because they wanted to let their customers invest. They saw value in that from a kind of brand building, community building, marketing perspective. And so that second use case, I just get really excited about. And when founders are like, maybe I'm raising a Series A and I've got 3 VCs who are interested, and I could give the last 15% of the rounds to another VC, but actually I think it would be really cool to let my customers invest. I think I get excited about that. Would do good things for my business. So let me, instead of bringing on a 4th shades of gray VC, let me kind of differentiate like the last 15% of my cap table by opening it up to my customers. So those are kind of the two use cases for WeFunder. I just found this tweet I did yesterday. Check it out. And this is kind of in line with Sedale's point. This company, Leah Labs, one of their investors said they were curing cancer in dogs. And so one of their investors, when they invested, we have a comment, why did you invest in Leah Labs? And this investor said, we lost 3 greyhounds to cancer. If this money helps to provide a survivable treatment for canine cancer, it is well spent. And for me, that was just one example among thousands of like what WeFunder is all about, which is investors, investing in companies, investing in causes, investing in founders they believe in. So yeah, that's just kind of in line with, as a founder, that second use case, what's the value that you might get from recruiting your community and your customers and investors? So sorry, that was a very long-winded tangent and answer to a question that you did not ask. But I think 2 use cases: one, help you as a founder raise more money more quickly, and secondly, let your community and customers invest because you think that will do good things for your growth and community, brand building, etc. So then to your actual question that you asked about 20 minutes ago on what makes for a successful WeFunder round, I talk about 3. My framework is kind of 3 things. So the first thing is it a good investment opportunity, right? So it's like, if you can easily raise from VCs and angels because your growth is up and to the right, hockey stick, explosive, and your total addressable market is huge, and your unit economics are amazing, and your customers love you, and you as a founder have like the perfect background, and your last company exited for $10 billion, et cetera, then you're going to easily be able to raise from VCs and angels in a world where WeFunder doesn't exist, and you will also easily be able to raise on WeFunder, right? And obviously it's a spectrum. like, the lower your valuation cap, that i.e. the more favorable the terms are of the investment for investors, the more attractive an investment opportunity is, the more money you'll raise. And so the point is obviously kind of pretty obvious, like the stronger the investment, the more successful you're going to be on WeFunder. I see some companies, it's like the valuation is just way too high. It's like not a compelling investment given the stage you're at. You're going to struggle to raise, and try to counsel folks as they're launching. But ultimately, we don't want to be kind of nannying or kind of paternalistically deciding what their terms should be. So generally more of an open platform, but that's one kind of tangible example there. So that's the first thing, is it a good investment? The second thing is around audience. So how big is the audience? Obviously, if you have 50,000 customers, then you can send an email and convert a few hundred of them, maybe a few thousand of them, to investors, and it can go very, very quickly, right? If you don't yet have an audience, you can use WeFunder to build an audience for sure, but the smaller of an audience you have, the harder it's going to be to fundraise, because you don't have that audience to pitch the investment opportunity to on day one. And the audience can be customers or users of your products. The audience can also be your LinkedIn connections, or people in your friends and family network. Everyone on your phone, right? So that's audience size. And then I also think kind of audience passion. So if you have customers that really, really love you, then you give them a chance to invest in your company, boom, right? So Mercury Bank, like I say, they raised $5 million in a day. They had 40,000 startup founder customers who just really love the product. They rave about the product. And so when Imad, the founder, gave them a chance to invest, they jumped at the chance. So you might have a really big audience, but if all your customers don't really know your brand, aren't really that stoked on the product, then the size of the audience is maybe less important, I would say, than the passion that the audience has for you. And so that's kind of on the audience side. And then the third part of the framework is around the founder kind of, I would say, hustle, or brilliance and creativity and ability to invest time and effort. Fundraising is usually hard work. It's usually can be a full-time job for a founder. And what's cool about WeFunder is we provide you with a bunch of new ways to fundraise. You can now go on a podcast and talk about it, put out a press release, use kind of TikTok to come up with like cool and creative videos to market the ability to invest in your company. Like, these are all new things that you can't usually do, but it takes you as the founder having the ability and the brilliance to come up with these ideas and execute on them. And then also the bandwidth and the time and the focus to dedicate towards investing the time you need, and usually you get out what you put in. And obviously on the WeFunder team, we're here to help you and kind of help you think through what the strategy should look like. But at the end of the day, ultimately, you as the founder need to have the dedication and the focus and the ability to make it happen. So that's the framework that I kind of use for what's going to determine success on WeFunder.
Yeah, that's great. I think I'll just touch on that. I think one of the things is certainly just like the hustle too. We were very, very grateful to have my team who sat down and we made a very intentional plan about like, what are we going to do with this WeFunder campaign? How are we going to get information out there? How are we going to disperse the updates above and beyond what we do on our WeFunder page? There's a lot of that like intentional kind of creativity and planning. But then there was also the fact that I just sat on my couch one night and literally texted everyone on my phone. Like,
dude, the texting thing, there's this founder down in San Diego, he raised $1 million on WeFunder. And like, I chatted with him like, I don't know, a few days before the end of his campaign. And at the time, I don't know how much he'd raised, like 500 or 600K. And I was just like, dude, just like text everyone on your phone. And he did it. And he credits that to a significant portion of his raise. And we've really optimized our checkout flow for mobile. It's super smooth on mobile. We find 2/3 of site visitors to the invest page are on mobile. So yeah, if you're fundraising, texting, great strategy.
Yeah. And honestly, like, we laughed because there's some friends like, way back in another life, I was a river guide, which are, river guides are not known as the most affluent of individuals. But, there were some folks I texted who I guided with who are now at, some bigger tech companies or other things who just rolled in with quite large checks that surprised surprised me. And so you never know, like that, that network of people that you have. Anyways,
I really want you to
big fan
take
of
me on
that.
a riverboat sometime. I think that would be fun. And yeah, just, I mean, on that point, $100 is the minimum check size on WeFunder.
Yeah.
The average investment is $1,000. So our average campaign, you raise 400K from 400 people. The median is just 250, and the minimum, you can actually set a higher minimum up to $1,000 if you want. But most people, as I said earlier, the reason you're doing this is you see a lot of value in engaging a large audience of people as investors in the company.
Mm-hmm.
And so therefore, lower the minimum to $100, have more people participate. Yeah. And then, yeah, really, like, obviously the number of people, it's not just legally now with regulation crowdfunding, you're legally able to accept money from unaccredited investors, but practically speaking, with Reg D, if your minimum investment is 25K or whatever you set it as, who can invest 25K in a risky startup, right? But if you lower that to $100, now way more people can invest. So the minimum check size, really, really cool. You can be an angel investor for $100 in a few minutes. I saw a stat the other day. I think it was 300,000 people have made an angel investment in the last 2 years, according to Google, by typing how many angel investors in America. I think it's 300,000.
Deeply scientific research then.
Deeply scientific, yeah, pretty serious, but like 0.1% of the population. So we're saying let's 100x that. That's our goal.
Awesome, I love it. And I will say, so I see all the cool questions coming in. I think we'll cut the sort of general questions a little bit short here. I have 2 more points I want to dive into, and then we'll open it up for Q&A. But I do want to double down on that some of the most incredible promoters and folks who have really made some great connections for OpenGrants have been folks who invested like $200 or $100. Like the network and the benefit of bringing these folks on board. It's one of the reasons that WeFunder's mission deeply resonated with us and that we went with WeFunder. But I want to dive into a couple tactical things really quickly, and then we'll get into the questions from the audience here, which I appreciate all of you. Thank you all for voicing your questions. I'm going to throw out another poll and then set up this next question. So the poll, just from the room, would love to hear, like, what is your biggest challenge right now? And hopefully we can use this to also frame some of our responses to your questions. So please do respond to the poll here, and we'll try to navigate the questions in the best way to hopefully support some of your biggest challenges. So as you're responding to that poll of just like, what's your biggest challenge right now? The 2 things I want to address. One is, we're all aware that there's a bit of an economic correction, call it what you will, going on right now, and that the climate around fundraising has changed. What are you seeing? What does that mean for equity crowdfunding? How are you seeing it impact in a certain way on the platform?
Yeah, I love the polls, by the way. You know what country runs the most polls of any country in the world? Poland.
The dad jokes.
You're welcome. I'm a dad of 3 kids, so have to get at least one dad joke in there. So yeah, I mean, to your question, macroeconomic impact on Reg CF investment volume. We're a 2-sided marketplace. So our investment volume every month is driven by, 1, what founders are launching on the platform, what companies are launching on the platform, and then 2, investors investing in those companies. And the first of those is by far the bigger driver of our investment volume. So if we have a Mercury or a Replit or a Levels, these are 3 companies that raised $5 million in a day on WeFunder. They're all Andreessen Horowitz backed, and then they opened up an allocation to their customers. So if we have a couple of companies like that launch in a week, then our week is amazing. And those companies are immune. Like $5 million is the max. They all sell it out in a day, and like you can't measure a kind of reduction in investment volume due to the market for those companies like that, because it's like they're just capped by the $5 million number, right? So it's like maybe they could have raised 25 million in an up market, and now they only raised 20 million in a down market, but they're capped at 5 million from their customers, and so they raise 5 million in a day anyway. But the point is that like the supply, the number of companies launching, and the kind of quality of companies launching is the main driver of investment volume. We've seen a slowdown in investment volume in the last few months. I would say maybe 25%. It seems to me mostly driven by a slowdown in supply. I don't have any data to back this up, but my intuition is that in the kind of entering into a recession, well, I know there's some debate on that, but founders are a little bit more skittish. Some of the folks answering the poll, I think, was cautiously optimistic. What's going to happen with interest rates? What's going to happen with growth? Is it going to be harder for me to fundraise from investors? Am I going to be able to command the valuation that I could have done 6 months ago, and maybe I could in another 6 to 12 months? And so I think founders have been just holding off a little bit over the last few months. I also probably think there's a seasonality thing that like over the summer months, like generally fundraising slows down. And so I think we've seen a bit of a slowdown in founders launching on the platform. There's probably also, I think, some slowdown on the investor side. It will be hard to believe that there's not. If you look at like Robinhood activity or crypto activity on Coinbase, like I imagine there's a slowdown on the investor side as well. It's a little bit hard for us to disentangle the two. My guess, based on nothing other than my own intuition, looking at investment activity and Wefunder very closely every day, my guess would be like 20% slowdown in investment volume, something like that. But nothing too much. And again, like I said earlier, nothing that you can't overcome. If you're running a runway, you need to raise some money, like, and obviously there's like the investor side of the equation. That's, as a founder, what do you need? And if you need to raise money now, then you can overcome it by, like I said earlier, having a growth chart that's up and to the right, having a strong investment opportunity, having an audience, and above all, like having the hustle to push it and work it and invest the time. So you can definitely overcome it, but definitely some slowdown to the market, just like I'd say pretty minor, certainly nothing drastic.
Great to know. I love, and this one's going to be like lightning kind of a couple notes. And thank you everyone for responding to the poll. I see a lot of the leader here is nailing down a funding strategy. Like how do we get that done? And I think, that's when I want to target this last little point to, and then let's move into kind of the Q&A session here. So one of the things that I think is super cool about Wefunder, and then we've touched on this a bit, and it's the other thing I think that's super neat about grants, and I mentioned this earlier, is that at least in my vision, this plays such a really cool space in like when you think about your capital stack, like the different kinds of money you're going to use to run your company. There's debt, there's non-dilutive money, there's grant funding, and these all like play different pivotal roles at different parts of your company. Where do you see yourself personally? Like, where do you see Wefunder ideally entering in the capital stack? Is it that like, hey, I'm trying to get this thing started and off the ground? Or is it, we just raised a Series B and we have all the money in the world, but our customers should invest? Or should you like raise a community round every time? Like, is that what you should do moving forward? And obviously there's maybe some bias there, but what are your thoughts?
It is going to be a biased answer. Everyone should do it all the time. Kind of seriously, I'll unpack that. I also just put my email in the chat. These are great questions. I see like a lot of questions. We probably won't have time to get through all 36 unless I start talking a lot more quickly than I have been over the last 30 minutes. So if you guys want to follow up and get into more detail, my email is there, jonny@wefunder.com. I mean, actually, genuinely, I do think this can fit across the spectrum. When we've seen founders use this, like from friends and family rounds, the first money in, through to Series B. And we're talking with companies that are Series C at this stage. So for the friends and family round, I honestly, again, I'm biased. I don't know why you would do a friends and family round not on Wefunder, because there's no compliance issues. You can publicly promote it if you want to. You can raise from unaccredited investors. You can lower the minimum check size to $100. The one downside is our fee. So you pay us 7.5% of the raise. That's the fee. That's the only thing you ever pay us. That is fixed. We don't charge you more if the investors are international or investing with a credit card. You pay 7.5%. There's no fixed fees to launch. You will never pay us anything else ever. That covers, we roll up investors to one special purpose vehicle, one SPV on the cap table, and that fee covers the creation of that SPV and the administration of that SPV in perpetuity. But that's the one downside, is the 7.5% fee. But I think we're worth it. We're also going to put you in front of Wefunder investors. They'll give a boost to the raise. So I think it's just streamlined. You can create a video and share that video, and that's so much leverage on your time as a founder. You still have to have conversations to pitch investors, but now you can share that video and just get so many more eyeballs on the company, and your raise. And so I again, I'm biased, but I think everyone running a friends and family round should consider Wefunder to supercharge and streamline their friends and family rounds, and then pre-seed, seed, Series A, and Series B. And it's basically, my pitch is, especially for consumer-facing companies, I think if you don't see any need or value or benefit from, recruiting your customers and community as investors, then there's less of a kind of reason to do Wefunder usually. But if you see value in engaging your customers and community members alongside VCs, then as part of every round, I would say, like up in Mercury, 120 million from VCs, 5 million from customers. And that's a really important point. Just to reiterate, this isn't an either or thing with conventional investors. Let's say VCs, right? It's not either I raise from VCs or Wefunder. I would say there's benefits of both. A lot of VCs are great. They take a board seat, they add value, they open their Rolodex, they can really help you to grow the company if they're really aligned with you on the vision and where you're taking it. But like, there's also a lot of value from recruiting an army of customers as investors. So do both. So really at any stage, I think it can kind of go hand in hand with other sources of capital. It can be for Main Street businesses, it can be for tech startups, it can be for biotech companies anywhere in the country. Like I say, we can do debt offerings. Most of what we do is equity. We do safes, convertible notes, price rounds. So for me, it's like, oftentimes it's like, okay, Wefunder, what is the right capital strategy for you? When are you going to raise capital? How much? On what terms? And then Wefunder can kind of plug in as a piece of that at any stage. Again, if either you see value in, okay, we're going to expedite and streamline the fundraising process, help you raise more capital more quickly, or if you see value in engaging your customers and community. But yeah, that can come at any stage. And,
awesome.
and in terms of sequencing, like, I think most of the startups that are raising capital at Wefunder, if they are kind of doing it kind of in conjunction with raising from VCs, let's say, I think the preference would be, I think the best practice will be, you line up the institutional lead for the round. They set the terms, maybe there's other VCs that are coming in, and then you allocate part of the round at the end of the round to let your customers and community invest, as opposed to doing it the other way around. Sometimes you can use the crowdfunding to create leverage and again expedite some of the conversations by creating urgency and FOMO. But I think generally the best practice, if you can find an institutional lead for the round, is to line that up and then add the community element in towards the end of the round.
Awesome. I love that. And yeah, I mean, I think the TLDR for me and all of this, and it is something that I've learned, this is my fourth venture-backed company, is just that you want to be very intentional and strategic about this. And unfortunately, I know there's always people asking about like, what's the best, or like, how do I do this? And honestly, the answer I've always given is like, you do it the way that makes sense for your company. And
totally.
That's how you do it.
There's very few kind of cookie cutter kind of templates. It's very, very bespoke. Totally agree.
Yeah. And I think one of the things I will add, and is that the Wefunder team did help immensely in helping us understand a bit of like how they could plug in, and just have those conversations. Reach out, definitely use Jonny's email, reach out to the team and just say, okay, well, this is what we're doing, like, how does this plug in? And that'll help you understand a bit more. I'm going to dive into the questions here. There's some like recurring themes, so I want to sum some of these up. One of the ones I see a lot is about just who you support in the world. So do you have to be a company based here in the United States? Can you support companies anywhere? What are your restrictions there, or how does that work?
So regulation crowdfunding, this SEC exemption can only be used to support companies that are legally registered in the US. So historically, we've been focused on companies with legally registered in the US. You can have operations internationally, but you need to have a Delaware C Corp or whatever. You don't need to be a Delaware C Corp, but you do need to be legally registered in the US. We are expanding in the EU soon. So to start with, that's going to open up companies that are legally registered in the EU or the European Economic Area, I think it's called EEA. The UK is no longer part of either, thanks to this little thing called Brexit. But so EU we can also do. Maybe that might open up kind of elsewhere in the world, but for now, those are the two geographies that we can support. Definitely would encourage you, if this way of raising capital is interesting to you, and I saw one question from someone I think was in Uganda, then just Google like investment crowdfunding in Africa or in Uganda, and I'm sure there'll be other more local platforms that are probably actually more suited to what you need than Wefunder. And certainly, at the moment, we can't support you unless you're in the US and the EU.
Great to know. Another theme that's come up a bit, if you could address, does this work for any kind of legal entity? Like if you're a nonprofit or you are a religious like mission, or so what are there any things that are excluded from using kind of this platform to do Reg CF or debt?
Mm-hmm. Yeah, so C Corps are most common, LLCs are quite common. We can't do S Corps. So if we've had S Corps convert to LLCs or C Corps and then raise on Wefunder, but as an S Corp, you can't raise legally. Investment companies are not allowed. So you can't raise like LP capital for a VC fund. We've actually had VCs raise with us, but it's slightly strange structure where like the operating entity is raising capital. We have had, I think, 2 nonprofits raise capital. There's no equity in a nonprofit, obviously, but I think we've had 2. I know one. I think there was another one as well that's basically raised debt capital. And so, it's probably a harder investment pitch, but you certainly can do that. But it's like pretty rare. But technically, nonprofits is a possibility as well.
Awesome, and that's a great segue. Can you touch just briefly on what the debt option is on the platform? What does that look like? Yeah,
so the same with debt as with equity is basically there's no kind of, again, like what you're saying earlier, there's no cookie cutter approach. It's kind of what you want to offer investors, right? So we have 2 standard loan templates on Wefunder. One is a loan that you would recognize, right? It's a loan with a term of X years, and you can change the X from 1 year, 3 year, 5 years, 10 years, and an interest rate of Y%, and you can offer a 2% interest rate or a 20% interest rate. And obviously, going back to the framework I gave earlier of what determines success, if you're a restaurant and you're offering a 2% interest rate loan to investors, that's pretty risky. You may still be able to raise some money from close friends and family, or maybe you give them perks. We haven't talked about perks, but maybe you say, if you lend me $100, not only am I going to pay you back 2% interest a year, but I'm also going to give you, a free appetizer every time you come into the restaurant. So you can kind of, the return for investors can be perks as well as, financial return. But the point is, you decide as the founder what kind of investment returns you're going to offer to investors. But if you don't offer them, interesting enough investment opportunity, then it becomes more like a donation. Going back to what I said earlier, it becomes more like a Kickstarter. And so then you're just going to raise less money. And so there's an elasticity between the generosity of the terms you offer to investors and how much money you're going to raise. And so we can certainly guide and help figure out the terms as a platform, as Wefunder, in early conversations with you, but we're not going to put any money in. And so our opinion actually shouldn't carry that much weight. The opinion, the people whose opinion matters is people that are going to write a $5,000, $10,000, $50,000 check. And so what you want to do as a founder is have conversations with investors that you want to come in and anchor the round and invest early in the round, and figure out the valuation, if it's an equity raise, or the interest rate, if it's a loan raise, with investors. And once you find, okay, I'm having good conversations with investors. If I'm offering these terms, this investment for these investor returns, then we can take that and put it up on the platform with confidence that there's going to be investor demand to invest on those terms. The other type of loan offering that we have is what's called a revenue share. So that's where you say, you know, I'm going to take 5% of my revenues or 7% or 3% of my revenues every quarter, let's say, and I'm going to pay that back to investors until the investors have been repaid a multiple on their principal. So if you raise $1 million on Wefunder, maybe the multiple is 2x or 1.5x. And so if it's 1.5x, you need to keep paying 3% of your revenues every month, every quarter, until investors have got 1.5 million back. And so that's like a revenue share based contract. So those are the two standard loan offerings that we do, but we also can accommodate bespoke offerings. Like sometimes there'll be movies that have like royalty contracts. Sometimes there'll be, you know, breweries and bars that have, or restaurants that have a preferred return for investors. So whatever unique and weird and wonderful investment contract you want to raise on, obviously you need to be pitching it to investors and generating investments from investors, but we can be pretty accommodating on that front.
Awesome. That's great to hear. I didn't know about the revenue share, but you know, love just, and I think I want to touch on this again because it kind of comes up quite a lot. I think, you know, there's a lot of possibilities and vehicles available for raising capital, and a lot of it once again has to do with like what works for your company. There's some great questions in here. That one of the other themes that's come up is like, what does the cap table look like in Reg CF? And I think that's a great question. There's concerns about like, oh, am I going to have now 100 investors on my cap table? Can you speak a bit to like what the cap table, and I can actually talk about what we did at OpenGrants, which is that we rolled everything up into an SPV. So it's just a single line on our cap table. And then the lead investor on that SPV actually has the voting rights and votes on behalf of everyone else on that SPV. But would love to hear your thoughts on just how folks manage that, if there's other ways, or what that cap table looks like for folks at the end of that Reg CF raise.
You nailed it. We use an SPV, a special purpose vehicle. It's a very common instrument in early stage fundraising. And so lawyers, VCs are used to it. The lead investor votes for the individual investors in the SPV. And yeah, we recommend using that. There are other options as well, but that's really what we recommend. Yeah, and that kind of there's no kind of issue from a cap table management perspective.
Great. There's quite a few questions about how much it costs to run one of these campaigns. Yep. And I'll just throw out my 2 cents and say that we spent no money on paid ads or anything like that. Leaned into our customer base, and you know, really it was a really low cost experience for us. But would love to hear your thoughts on that. I think, you know, once again, this is probably very company dependent.
Yeah, totally. So we charge a fee of 7.5% of the amount raised. So that's the biggest cost. And then if you're using one of our standard investment contracts, so we have a standard loan contract, revenue share contract, we have a standard safe contract, Y Combinator post-money safe contract, we have a Cooley convertible note. If you're raising on a priced round, you would want a lawyer to draft a custom subscription agreement. And so there's a legal cost there if you're raising on a straight equity priced round. If you're raising on a safe, you can avoid the legal fees. We take care of the SEC Form C filing for you. So most startups are not paying a lawyer. Actually, I think most startups at Wefunder are not paying a lawyer anything for the whole thing. Again, if you want to do a price round, there would be a fee to get a lawyer to draft an investment contract there. But that's a minority if Wefunder raises. There's one other cost as well that you would incur, which is if you're raising more than $107,000, previously $250K, but the SEC just recently lowered it to $107K. So if you're raising more than $107K, and this is actually a good point of one of the few downsides of regulation crowdfunding that I think still exists, and I should point to, you need to publicly share financials. That's like the downside. So if you are really reluctant for your revenue, P&L, cash flow statement to be out there in the world, it's not a great fit for you, because you have to publicly share that with the SEC as part of your legal filing when you formally launch the campaign. And so, sharing those gap financials is a requirement for every company. If you're raising more than 107K, you need to have an independent CPA and accountant do a review of your financials. And if you're raising more than 1.07 million, then you need to have a CPA do an audit of your financials. And depending on how complicated your financials are, there'll be a bigger or smaller cost to that. So if you're a very early stage startup, you don't really have many financial transactions yet, getting a review done is probably $1 or $2 grand. If you're a brewery or a bar with like thousands of transactions and your books are a total mess, then to get an audit done might be 20 grand. And so it really kind of varies. And so that CPA cost is one that you would pay. You can actually start fundraising on Wefunder before you have that, but certainly before we send you any money, you would need to pay that cost if you're raising more than 107K. So those are costs that everyone pays. And then, as Sedale mentioned, some founders will pay money to a marketing agency to help them on the heavy lifting of the campaign, marketing execution, writing all the copy of the emails. And our role is more on the strategy side. We're not going to write the emails for you or write the ad copy for you or get super, spend like, dozens and dozens of hours on execution. So if you want help with that, which some founders do, you would pay for a marketing agency to work with you on that. And then some founders also are paying ad spend to raise the money. We generally don't love that as a model. It becomes a pretty expensive way to raise capital. And we say, if you need to spend a lot of money in ads to raise the capital, we just get a little squeamish about that. I think where that can work is if you're a consumer-facing company, let's say, and you can generate revenue. If the ad spend serves a double purpose of one, raising the capital, but two, then basically acquiring customers that you can make a lifetime value revenue from in the future, I think that can get quite interesting. I would say the average company on Wefunder is spending 5 cents on the dollar on a marketing agency and ads. But obviously Sedale and a lot of companies are spending zero. And the Mercuries of this world and the Replets of this world that raise 5 million in a day, they send an email, raise the money, no worry about ad spend or marketing spend or anything like that. And so again, as Sedale mentioned, it kind of depends. Like if you have a huge audience and if you have an amazing company that everyone wants to invest in, there's no ad spend. Like the harder it is for you to raise money, maybe you want to like juice it with some ad dollars. It can make sense to do that. It's a pretty small minority, I would say, of Wefunder companies.
Yeah, great stuff. So I want to go through maybe just sort of like a rapid fire series here. We have 7 minutes left. And so I'm just going to fire these away at you. And if you can keep the answers as short as possible. And then, as mentioned, please, if you have questions, I saw one question here about just reaching out to the Wefunder team. Jonny's been good enough to leave his email there in chat. Please feel free to reach out. You can reach out to our team as well. We will send contact information out after this. And I do want to just say also thank you all for being here. If we don't get to your questions, we'll send follow-up to some other resources as well. So let's start with some of these. There's a question here. So it's illegal to raise money, saying it publicly, fanfare style on social media. Not necessarily, but if you're selling equity, that part is definitely something to navigate. And that's what Reg CF really opens, is the ability to publicly solicit for an equity raise. But you could go out and run a Kickstarter campaign all day long, and that's perks-based crowdfunding, so it's different. Also, I just took that one, sorry. But we just talked about marketing. Question here. So it's basically a friends and family round on steroids. Would you characterize it like that?
I think if you're running a friends and family round, I think you can characterize it as that. If you're doing this as part of a Series B, I probably wouldn't characterize it as that.
Yeah.
we use the phrase community rounds, I would characterize it as an allocation of a Series B, a community round that's like part of a Series B. So I would probably only use the phrase friends and family round if your overall raise is at the friends and family stage.
Awesome. Do VCs view using equity crowdfunding as a positive or negative thing?
I think it depends on the VC. I think like VCs will probably view other VCs as a positive or negative, right? Like if you have Andreessen Horowitz or Sequoia in your Series A, then that's really going to help you raise the Series B. If you have kind of family office that doesn't have the name recognition, that's going to carry less weight in the next round. So there's a spectrum within VCs. I think like, you know, there's probably some VCs that look down their nose at equity crowdfunding. My analogy is like the Hilton hotel owner probably looked down their nose at Airbnb in 2010. That's the analogy for me. You know, Wefunder is Airbnb for the hotel industry. So there probably is some snootiness, but like I'm seeing more and more VCs who it's not just like, okay, now that you guys fixed the SPV cap table issue, okay, that like solves the kind of downside that we were looking at, because that's a relatively new thing. The SEC allowed for SPVs a year ago. Before that, the cap table situation was bad. So that now changed, which is really, I think, solved the biggest problem with Reg CF. But now more and more VCs are actually buying into the positives. So if I'm investing in consumer-facing companies, yeah, I actually kind of buy this Wefunder pitch that if my portfolio companies can recruit thousands of those consumers and customers as investors, that's going to accelerate their growth, which is good for my portfolio performance. So again, it depends on the VCs. But if you go to communityround.com is a great website. We rolled this out in April. Check it out. I just put it in the chat. And on there's a number of VCs that are kind of have quotes of like that we have relationships with that are basically like, yeah, this is the future of fundraising. Alexis Ohanian talks about this being the future of fundraising. We have a number of A16Z portfolio companies that have done Wefunder, and I think more and more VCs are seeing this not just like, okay, like absence of a negative, but actually, yeah, this can really help my portfolio companies. But it depends on the VC.
Awesome. Another good one here that I think is short and fits in our last 3 minutes. Does Wefunder help with the legal obligations of the startup and the investors?
We help with the Form C filing, which is the legal requirement to launch a Reg CF campaign and the closing. So yeah, we take care of that. There's one other legal requirement. You need to file an annual report the year after you raise. So for Sedale in April of 2023, you'll need to file an annual report. So you would do that. We have a tool that you can use on Wefunder to do that, but you would kind of take care of that using our tool usually. So for the most part, yeah, we're doing the Form C filing with you.
Awesome. I am going to go, let's see. There's a lot of questions about company stage in here, like what stage needed to be. You can raise whenever you're ready. Your company just needs to be incorporated. And
one point on that, Sedale, just to make clear, Wefunder is an open platform. So if you incorporated yesterday, actually you can raise pre-incorporation technically, but you need to incorporate before you file the Form C, but you can start fundraising even pre-incorporation. But if you incorporated yesterday, you can file a Form C and raise on Wefunder. We don't want to be a gatekeeper. We want to let anyone have the chance to invest. We don't want to decide whether you're worthy or not to raise money. As with all fundraising, imagine if a world where Wefunder doesn't exist. If you don't have any traction and investors don't see anything why they would invest, you will struggle to raise money in a Reg D world from angel investors or friends and family. And you will also struggle to raise money on Wefunder. So Wefunder, technically open platform, no barriers, but it's really on the question. I turn it back to you as the founder. Can you raise money from investors? And if so, we'd love to have you do it on Wefunder.
Yeah, and I will just speak. I kind of want to close on this point because I think this is a great question. In terms of your capital stack, maybe fundraising when you have no traction, no product is not great. But
Right.
Grant funding can be grant funding is a great place that fits on that part of your journey. So I just want to thank everyone for being here. Thank you so much, Jonny, for sharing your insights into this space. I personally am very excited about where equity crowdfunding and crowdfunding can take just people in general and businesses. Very excited about this kind of evolution. So just want to thank you all for being here. Please do check out the resources that are in the chat. Apologies if we did not get to your questions. We will do a variety of follow-up, both via emails, and then please do feel free to reach out to myself or the team. I'm going to go ahead and share my screen again, just so y'all can check out this. You can pop over to OpenGrants as well, and you can sign up, and we have a ton of resources. There was some questions about getting grants, tons of resources there as well. So thank you all for being here. Thank you for joining us. This will be available post in a YouTube as well as via email. So definitely check in. Be sure to check out Wefunder, check out OpenGrants. And Jonny, any parting words of wisdom for the folks on the line?
Well, I'm looking forward to the riverboat guide ride soon. Yeah, I mean, we've talked about the founder side. If you're a founder looking at raising capital, check out Wefunder, learn more. I put my email in the chat. Feel free to email me and we can give you more info. And also on the investor side, check it out. We have hundreds of companies fundraising on Wefunder. Maybe you've never angel invested in a company before. Now you can be an angel investor for $100. It's very easy if there's a cause or a company that kind of catches your eye. So wefunder.com/explore. You can browse through different investment opportunities. So yeah, again, thanks for having me, Sedale, and yeah, I hope we can help some of the folks in the audience here.
Awesome. Thank you all. Thanks everyone. We'll see you at the next one. Take care, and we will be in touch.